In August of the year 2000, this company was the seventh largest corporation in America. Its stock traded at $90 a share. Wall Street analysts called it the future of business itself. Fortune magazine had just named it America's most innovative company for the fifth year in a row. 16 months later, its shares were worth 26 cents. 20,000 employees lost their jobs. Many lost their entire retirement savings on the same day. And the men at the top? They had already cashed out hundreds of millions. This is the story of Enron, the $74 billion lie that fooled Wall Street. Every empire of paper begins with a true believer. Enron's was Kenneth Lay, a Baptist preacher's son from Missouri who grew up poor, earned a PhD in economics, and became obsessed with one idea: that energy should be traded like any other commodity. No regulations, no limits, pure markets. In 1985, Lay merged two sleepy pipeline companies, Houston Natural Gas and Internorth, into a single firm. A consultant famously suggested the name Enron until someone checked a dictionary and discovered it meant intestine. They shortened it to Enron. For its first few years, Enron did something almost quaint. It moved actual natural gas through actual pipelines. But Ken Lay didn't want to run a pipeline company. He wanted to run a revolution. And for that, he needed a man with bigger ideas. He found one at McKinsey. Jeffrey Skilling was a Harvard MBA and a McKinsey consultant who believed intelligence was the only virtue that mattered. He joined Enron in 1990 with a vision. Enron shouldn't own things. Pipelines, power plants, steel in the ground. That was the old economy. Enron would become a trading house, a bank for energy. It would buy and sell the future itself. But Skilling had one condition before he'd take the job, and it's the condition that would eventually kill the company. He demanded Enron use an accounting method called mark-to-market. Here's what that means, and stay with me, because this is the engine of the entire fraud. Under normal accounting, if you sign a deal that earns money over 20 years, you record the profit as it actually arrives, year by year. Under mark-to-market, you estimate the total future profit of the deal and book all of it today. Think about what that does to a company. The day you sign a deal, you record 20 years of imaginary profit. Next quarter, that deal contributes nothing, so you need a bigger deal with bigger imaginary profits just to stand still. It is a treadmill that only speeds up. Enron wasn't reporting money it had made. It was reporting money it had promised itself it would make. Inside the company, Skilling built a culture to match. Every 6 months, employees were ranked against each other, and the bottom 10 to 15% were fired. They called it rank and yank. Question a deal's numbers, and you weren't rigorous, you were weak. The message was simple: make the numbers or disappear. By the late 90s, the treadmill was spinning too fast. Enron's real businesses, and some were catastrophically bad, like a power plant in India and a disastrous broadband venture, were bleeding cash. The imaginary profits were on the books, but real debt was piling up. If Wall Street ever saw that debt, the stock would crash. Enter the magician, Chief Financial Officer Andrew Fastow. Fastow's trick was to create hundreds of shell companies, special-purpose entities with names out of Star Wars. Chuco, the Raptors, LJM. On paper, these were independent partnerships. In reality, they existed for one purpose: to buy Enron's failing assets and absorb Enron's debt, so that none of it appeared on Enron's balance sheet. Who guaranteed those shell companies against losses? Enron, with its own stock. Follow that logic to its end. Enron was insuring itself against itself with itself. The entire structure only stood as long as the stock price kept rising. If the shares ever fell, the guarantees would trigger. The hidden debt would come rushing home, and the whole machine would detonate at once. And Fastow made sure to pay himself handsomely for running both sides of the deals. over $45 million. Where were the auditors? Arthur Andersen, one of the 5 most prestigious accounting firms on earth, was collecting $1 million a week from Enron. They signed off on everything. By 2000, the illusion was perfect. Revenue, $100 billion. The stock, $90. Analysts who questioned the numbers were mocked. On one infamous conference call, a fund manager pressed Skilling on why Enron couldn't produce a balance sheet, and the CEO of a Fortune 10 company responded by calling him an obscenity. The room laughed. Nobody laughs at the top of a mountain, unless they're nervous. And in California, Enron's traders found their masterpiece. When the state botched its energy deregulation, Enron traders learned to game the grid, creating artificial congestion, shipping power out of state and selling it back at inflated prices, with strategies they nicknamed Death Star and Get Shorty. Californians endured rolling blackouts while Enron's trading desk printed money, and traders joked about it on recorded phone lines. That's worth pausing on. This was not a company that drifted into fraud. This was a culture that celebrated it. Then, in August 2001, something strange happened. Jeff Skilling, 6 months after finally becoming CEO, abruptly resigned. He cited personal reasons. The stock wobbled. Inside the building, a vice president named Sharon Watkins sent Ken Lay a now famous warning that the company could, in her words, implode in a wave of accounting scandals. Lay's response was to reassure employees the stock was a bargain, while he kept quietly selling his own shares. Over the years, he'd offloaded about $184 million worth. The unraveling took 16 weeks. In October, Enron announced a mysterious billion-dollar write-down and a shareholder equity reduction tied to Fastow's partnerships. The SEC opened an inquiry. Fastow was fired. Enron admitted it had overstated profits going back years. A rescue merger with rival Dynegy collapsed when Dynegy's accountants looked under the hood and ran. At Arthur Andersen's offices, the shredders were running around the clock. On December 2, 2001, Enron filed for bankruptcy, at the time the largest in American history. Employees were given 30 minutes to clear their desks. Their retirement accounts, stuffed with Enron stock the company had encouraged them to hold, were vaporized. Shareholders lost $74 billion in 4 years. The executives had already sold. The magician talked first. Facing 98 criminal counts, Andrew Fastow pled guilty to 2 and turned on his bosses. He served 6 years. Jeff Skilling was convicted on 19 counts of fraud and conspiracy and sentenced to 24 years, later reduced when he forfeited $42 million. Ken Lay was convicted too, but died of a heart attack before sentencing. So, under American law, his conviction was erased. He died a legally innocent man. Arthur Andersen, the 90-year-old firm that audited the lie, was convicted of obstruction of justice and surrendered its license. 28,000 American jobs gone with it. Congress responded with Sarbanes-Oxley, the law that still forces every CEO in America to personally certify their company's numbers. Every financial report you've read since 2002 was shaped by this collapse. Enron's executives were called the smartest guys in the room. Maybe they were. But the lesson of Enron isn't about intelligence. It's that a lie compounds exactly like interest, quietly, invisibly, until the day it comes due all at once. 16 months, $90 to 26 cents. If you want more stories about empires built on paper, like the woman who fooled Silicon Valley out of $9 billion with a single drop of blood, that story is next. Subscribe so you don't miss it.